Welcome to Akesha's Foreign Exchange Made Easy class. Today is 17th session. Last day I have discussed initial margin and mark to market margin. Today I will continue this and start a new chapter, option derivative. Now come to a problem. Last day I have discussed the accounting entry on initial margin and mark to market margin. Now come a problem. In 10 days future contract transaction, the trader's mark to market profit or loss amount is given in the following table day wise. On specified day, deposit initial margin money, that is rupees 1 lakh. You know, every participant, buyer and seller, bring initial margin specified by exchange before to get the entry in the future trading. So here the initial margin amount is 1 lakh. So the buyer and seller both will deposit this amount on a specified day before the to allow in the future trade. Day 1, the profit of MTM transaction is 12,000. Day 2, loss on MTM transaction is 15,000. Day 3, MTM loss is 18,000. Day 4, loss on MTM transaction is 14,000. And you see that the maintenance margin is rupees 75,000, and this should be maintained. If it falls below the maintenance margin 75,000, then the broker call a margin call to the participant just to bring the sufficient amount to bring back the initial margin to the original position, that is rupees 1 lakh. And day 5, loss on MTM transaction is 12,000. Day 6, MTM profit is 11,000. Day 7, profit is 10,000. Day 8, loss 15,000. Day 9, profit 13,000. And last day, loss on MTM transaction is 12,000. The accounting entry will be as follows. Initial margin. First, deposit money to the initial margin, that is margin account, that is bank. Initial margin account debit to bank 1 lakh. Now profit 12,000. It will be initial margin account debit to MTM 12,000. And loss MTM account debit to initial margin 15,000. And next loss 18,000 is credited to the initial margin account. Loss is credited to the 14,000. Now the balance falls below the maintenance margin 75,000. So the participant has to bring 35,000 to make the account equal to 1 lakh. So next day, MTM margin loss is 12,000. This day it can be deferred, but this is the procedure. Day 6, MTM profit is 11,000, that is initial margin account debit to MTM. And next day profit 10,000. On 8th day, there is a loss, so MTM account debit to initial margin 15,000. Profit initial margin debit to MTM 13,000. And last day, 10th day, that is for loss, so MTM account debit to initial margin account. So the remaining balance 95,000 will be refunded to the participants. 95, that is bank account debit to initial margin account. Now come mark to market. Here you get the profit or loss of the transaction. That is first day there is a profit, initial margin account debit to market 12,000, and loss are MTM account debit to initial margin, and profit will be initial margin account debit to market. So by this you will compute the profit of 40,000, and that will be this is loss of 40,000, and this will be adjusted to the PL account. Next comes a problem. Mr. X buys a future of XYZ company at rupees 2,500 per share for one lot, and lot size is 250 shares. The contract size is 6,25,000 rupees, 6,25,000 for a period of 10 days. The initial margin of this will be the 8 days, not 10 days, it will be the 8 days, because 8 days transaction is given here. The initial margin is 20% of the contract value, that is rupees 1,25,000. That is 20% of 6,25,000 is 1,25,000, and maintenance margin is rupees 1 lakh. The closing price of share of for 10 days is given below. Buying price 2,500, initial margin is 1,25,000. Next day the closing price is 2,540. Make a profit of rupees 40 per share. So for a lot size it will be 10,000 profit. The initial margin becomes 1,35,000, and next from this the price increase rupees 35,000 makes a profit, total profit 35 per share profit. So profit for a lot, that is 8,750. The initial margin balance will be 1,43,000. Next day 50 per share is the loss. So 50 into 250, 12,500 is loss, total loss. The initial margin account comes down to 1,30,500. Next the total profit is 20,000. A total loss is 20,000. The initial margin falls to 1,10,500. Next day total loss is 18,750. So initial margin account, the amount will drop to 91,750. Here on 6th day there is a profit, so the balance will comes 1,37,000. Here when it is comes to 91,750, the initial margin maintenance margin is 33,250. The participant bring this amount, and to make this amount the balance to 1,25,000. Next day is the profit 15,000. It will be 1,52,500 initial margin, and day 8 there is a profit, and 17,500 is a total profit. The balance is 1,70,000. Now from this you can calculate the net profit, that is the initial, that is the last closing price minus the future price, spot future price, that is 50, multiplied with 250. Since the closing price on expiry date is higher than the spot future price, there is a profit. 12,500 will be the profit. So to compute the profit, you take two figure, that is spot future rate and expiry future rate, and difference between this rate multiplied with lot size, you will get the profit or loss. Now, initial margin account. On specified day, the deposit from bank is initial margin account debit to bank 1,25,000. Profit MTM, initial margin account debit to MTM 10,000. Next day also debited 8,750. Now loss is 12,500, that is MTM account debit to initial margin 20,000 and 18,750. Now the balance falls below the 1 lakh. So the party will bring the fund 33,250 to bring back to the original position 1,25,000. Now profit 12,500, 15,000, 17,500, and the last balance is closing balance of the initial margin is 1,70,750 that will be refunded to the party, that is bank account debit to initial margin account 1,70,750. This money refund can be calculated as opening balance, that is 1,25,000 plus maintenance margin money, that is 33,250 plus profit 12,500 is equal to 1,70,750. If it is loss, it will be deducted from this. That if surplus, then that will be refunded to the party. Mark to market account. Now, mark to market account, that is profit 10,000, that is initial margin account debit to market, that 10,000, initial margin account debit to 8,750. Now loss 12,500, that is MTM account debit to initial margin account 20,000, the same account entry and 18,700. In this account you will get profit or loss. Now 12,500, 15,000, 17,500, and ultimately you see that 12,500 is the profit. So this will be adjusted with the profit and loss account. This is credit balance. So it will be credited to the PL account. Now this profit is added here, 12,500, to arrive the money to be refunded to the party 1,70,750. Next come option trading. A option is a derivative, a contract that gives the buyer the right but not obligation to buy. It is a call option. Or gives the buyer a put option the right but not obligation to sell the underlying asset at a pre-specified price known as strike price on a certain date known as expiry date. There are two types of option, call option and put option. Buyer of call option has the right but no obligation to buy the underlying asset at a pre-specified price known as strike price and on a certain date known as expiry date. Traders buy call option when they anticipate that the market price of the underlying asset will rise in near future. Buying a call option is called long call. Traders sell the call option when they anticipate that the market price of the underlying asset will fall in near future. they have the obligation to sell the underlying asset when the buyer of call option exercise it. Selling a call option is called short call. Take for example that a real estate trader want to buy a land from the owner worth of rupees 10 lakh with a view that price of land will increase and he will sell the plot at higher price to make a profit from the transaction. So he gives a token money of rupees 1 lakh to the owner who sell the plot and agree to pay full amount within 3 months. Now, if the market price of the land increase, then the trader will buy the plot from the seller at rupees 10 lakhs and sell it to a customer at market price which is higher than the buying price and make a profit. Now, if the market price of the plot falls below 10 lakhs, the trader will not buy it, incurring a loss of rupees 1 lakh, the token money paid, and the seller will gain this amount. So here, the buyer has the right but not obligation to buy the asset, but seller has the obligation to sell the asset if the buyer exercise is right. This is the strategy of the buyer of the call option. At the time of contract, the buyer of call option has to pay the premium to the seller, that is token money of call option. Token money of my example, the buyer of call option will exercise this option when the price of the underlying asset is higher than the strike price. Strike price in my example is 10 lakhs and premium is 1 lakh. And do not exercise the option when the price of the underlying asset is equal or less than the strike price. For example, a trader buys a USD INR call option at a price of rupees 70 per dollar, which is called strike price, to be settled after 1 month, that is expiry month. The expiry date, the date on which it will be settled, it is called expiry date. On the expiry date, suppose the spot price of USD INR is higher than the strike price, say rupees 72 per dollar, the investor will exercise the option by buying at rupees 70 per dollar from the seller by contract, it is a contract, and sell it at 72 per dollar in the market, gaining rupees 2 per dollar, and this will be reduced by the premium paid to the seller. Let the premium is rupees 1 per dollar, so the net gain will be rupees 1 per dollar. If the lot size is $1,000, then the total gain will be $1,000. The buyer will not exercise the call option when the spot price on equity on expiry date is equal or less than the strike price, and here the seller will gain, which is equal to the premium received from the buyer, and the buyer will incur a loss which is equal to the premium paid to the seller. Now come put option. When a trader buys put option, he has a right but not obligation to sell the underlying asset at strike price and on expiry date. The seller on put option is obliged to buy the asset from the buyer of put option if the put buyer exercises his right. Trader buys put option when he anticipates the market of the underlying asset will fall. The buyer of put option exercises his right when the spot price of the underlying asset is less than strike price, so that he will buy it from the market and will sell it to the seller of put option at the strike price and gain from the difference. He has to pay premium to the seller of put option, and this will be deducted from the above gain to get the net cash profit. The buyer will not exercise the put option when the spot price on expiry date is equal or higher than strike price, and here the seller will gain, which is equal to the premium received from the buyer. For example, a trader buys put option USD INR at the rate rupees 70 per dollar, which is strike price, to be settled after 1 month. He has to pay the premium rupees 1 per dollar to the put seller. On expiry date, the spot price of USD is rupees 68 per dollar. Then the trader will buy USD at rupees 68 from the market and will sell it to the put seller at rupees 70 by contract, gaining rupees 2 per dollar, and the net cash inflow will be rupees 1 per dollar after deducting the premium of rupees 1 per dollar. If the lot size is $1,000, then the total cash flow will be rupees 1,000. This is similar with the future trading. But there is no premium. Here the premium paid to the seller if the buyer of call option and put option do not exercise their right, and then they will suffer a loss equal to the premium. But in future, it is not to the loss and gain will be as per the transaction, not to the premium paid. The buy option is called long, that is long call or long put, when the trader buys a call option or put option. The sell option is called short, that is short call or short put, when the trader sells a call option or put option. Difference between long call and long put. When a trader buys a call option, it becomes a long call. He pays the premium to the seller of call option, known as trader of short call or writer. When a trader buys a put option, it becomes a long put. He pays the premium to the seller of put option, known as trader of short put or writer. Nature of activity. Long call. Trader of long call buys the underlying asset at strike price, paying a premium to trader of short call, and on expiry date, when the asset price is higher than the strike price, he will exercise it. Otherwise, he will not exercise his right. Long put. Trader of long put sell the underlying asset at strike price to the trader of short put, who buys at per contract. When the asset price is less than the strike price, the buyer of put option will buy the asset from the market at lower price and sell it to seller of put option, thus gaining from the operation. In long call, the trader will not exercise his right when the underlying price is less than the strike price. Similarly, in long put, trader will not exercise his right when the underlying asset price is higher than the strike price. The loss of long call and long put is limited, which is equal to the premium paid. But the gain from the operation in long call and long put is unlimited. In long call option, the trader's strategy is bullish in his market view and expect the market to rise in near future. In long put option, the trader's strategy is bearish in his market view and expect that the market to fall in near future. Now come short call. A short call trader is obliged to sell the underlying asset to the buyer of call option if the option is exercised. A short call is bearish trading strategy in his market view and expect the market will fall in near future. Short call holder will face a substantial loss if the spot price rises above the strike price of the call option, or will make money from the premium if spot price is equal or fall below the strike price and the option expire worthless. Short put. Short put trader is obliged to buy the underlying asset from the buyer of put option if the option is exercised. A short put is also known as an uncovered put or naked put. A short put holder will face a substantial loss if the spot price falls below the strike price of the put option, or will make money from the premium if the underlying price remains higher or equal to the strike price and the option expire worthless. In short put option, the trader's strategy is bullish in his market view and expect the market to rise in near future. The gain of short call and short put is limited, which is equal to the premium received. But the loss from operation is in short call and short put is unlimited. The relevant points of call option and put option in a nutshell is given below. The right to buy the asset is called call option, and the right to sell the asset is called put option. The pre-specified price is called strike price, and the date at which the strike price is applicable is expiry day, that is called. Difference between the date of entering into the contract and the expiration date is called time to maturity. The party who buys the right but not the obligation and pays premium for buying the right is called option buyer. And the party who sells the right and receives a premium for assuming such obligation is called option seller or writer. The price which option buyer pays to option seller to acquire the right is called option price or option premium. The asset which is bought or sold is also called an underlying asset. Buying an option is also called as taking a long position in an option contract, and selling is also referred to as taking short position in an option contract. The long call and short put are bullish nature, and short call and long put are of bearish nature. Today I stop the class here. Next day I will continue this option trading. Thank you.